Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal. It's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO of Deal Room and chief scientist at M&A Science. Today, I'm joined by Ryan Gable, managing partner at BW Forsyth Partners, a St. Louis-based investment firm backed by Barry-Wehmiller. Ryan co-founded BW Forsyth in 2009 with a unique approach that blends elements of private equity, family office investing, and strategic M&A. Since then, his team has completed over 55 acquisitions and built 7 platform companies across capital equipment manufacturing and insurance services. Today, we'll explore his firm's investment philosophy, how they cultivate relationships with sellers, and why their buyer-led M&A approach has driven long-term success. How's it going, Ryan?
Great. Kisan, thanks for having me. Appreciate the invite. It's going to be fun.
Hey, thanks for hosting me here in Manhattan, like literally 5-minute walk from where I live. So that made it super convenient. Is this one of your...
Yeah, so this is one of our platform companies, core partners. This is one of their offices.
Cool. I like it. It's a buzzy office.
It's a very nice, just trying to make it easy for you.
We're going to make sure you get the Manhattan. We're going to hit little sirens in the background if the processor's not editing them out. Can we kick things off a little bit about your background?
Sure. Born and raised in St. Louis, then went to undergrad at University of Richmond, got kind of a traditional business degree with a focus in finance and international business. And like all finance majors, at least back then, you were told you wanted to be an investment banker. So I really wasn't sure what I was getting into, but followed everybody else and ended up working for Bank of America's investment banking group and their leverage finance group as an analyst did that traditional 2-year stint in Dallas, and then was fortunate enough to get hired into their private equity group. This was back in the day when banks could still have internal private equity groups and hedge funds before the financial crisis. So joined what was called Bank of America Capital Investors in 2001. That's now Ridgemont Equity Partners, since they spun out after the financial crisis. And Charlotte for about 8 years. And then we'll get into this more later, I'm sure, but Bob Chapman, CEO, majority owner of Barry-Wehmiller, approached myself and Kyle Chapman, his son, back in 2008 and 2009 to move back to St. Louis to start up Forsyth. So that's the professional background. Personal side, as I said, born and raised in St. Louis, back there now with my wonderful and very patient wife and 3 kids and loving it.
That's awesome. So you did the banking, got on the investment side, and then what happened? You get a phone call from Bob or Kyle, and they said, "Hey, I got this idea I want to pitch to you." Well, how'd that go down?
Yeah, so Kyle, who's currently was the co-founder of Forsyth with me for the first 10 years, he's now over on the Barry-Wehmiller side running that whole group alongside his father. But Kyle and I were working together at B of A's private equity group. And we had talked about and looked at buying some small businesses with the backing of Barry-Wehmiller around the Southeast for a couple years towards the end of our time at B of A Capital Investors. We never ended up doing it, never came to fruition. But from that, I think he had been in discussions with his father and some of the other Barry-Wehmiller folks and leadership team members about, hey, there's a different way to do business. There's a different way to be a acquirer of businesses. And so, yeah, I think Bob and a couple of the Barry-Wehmiller board members I discussed this for a couple years and then finally approached Kyle and me in early 2008 to potentially do this. Oh,
so you already got familiar with them through the banking or through their investment relationship and / banking, and then that manifested.
Yeah, I like to think I was picked due to my merits and abilities, but the fact that I was originally from St. Louis probably made an easy selection too. But yeah,
he's just down the street.
but we worked together for 8 years at Bank of America, so I knew each other well.
Awesome. Yeah, because Kyle was there.
Yep.
So you worked with him.
Yes.
I got to put a plug in for both Kyle and Bob Chapman. I did a podcast with them. So if anybody is not familiar with Barry-Wehmiller, check it out. Very interesting organization. You go on their website, like read about the culture. It's just such a different approach. And it's, for me, we were talking about earlier, it's like inspiring just to see how your approach has influenced other very large organizations. Some like LCI have had on the podcast. I know we have another one coming up, and just completely changed their approach to culture and the way that affects, or the way it influences how they do M&A.
Yeah, it's had a tremendous impact on Barry-Wehmiller and the success of that business and all the team members and people whose lives they've touched. But I'm sure we'll talk about this later. I mean, it's a huge advantage for Forsyth. It is, the Barry-Wehmiller backing, that people-centric culture, that long-term approach. It is what has made a success. Kyle, myself, the other 15 team members in Forsyth, we've been a big part of it. But the backdrop still sits on the model, the story of Barry-Wehmiller. People-centric culture is a good way to put it. So if you get a chance, check out that podcast. You learn a lot about it. It's really incredible. Just the sheer success they had with the parent organization. Let's click into BW Forsyth's model. How do you differentiate it? What is it? Yeah, and you've mentioned Barry-Wehmiller a little. I think it's important to understand who Barry-Wehmiller is and how we play into it. So Barry-Wehmiller is about a $3.6 billion revenue business. It was founded in 1885 in St. Louis, and really for the first 100 years of its existence, made bottle washers and pasteurizers for reusable glass beer bottles. St. Louis, Anheuser-Busch, that's why we're there. Bob's father actually bought the business in the 50s from Mr. Barry and Mr. Wehmiller. He ran it for 20 years. Bob took over in the late 70s and really transformed that business from one customer, one industry, very fragile business overall, to building it to about $1 billion in the late 2000s when Kyle and I joined. And then today it's, as I said, a little over $3.5 billion. And when you look at Barry-Wehmiller Group overall, about $2.6 billion of that revenue is Barry-Wehmiller Companies, which is mostly packaging and packaging-related equipment, and then also engineering consulting. And the other $900 million is the Forsyth businesses that we'll get into here, those 7 platforms that we've acquired and built up over the last 15 years.
So they got a big success on the parent organization. Why fork off and do something different?
Yeah, so Bob and the board, really in the mid-2000s, as I said, they'd grown from $20 million in revenue in 1987 to about $1 billion by 2008. And the majority of that growth had been by buying distressed or at least underperforming packaging equipment businesses. And they looked up, and really, probably because of the law of large numbers, they'd been growing at 15+% a year. And now you're $1 billion, and it's much harder to grow at that rate at $1 billion than when you were 20 million. And they stepped back and said, hey, everything that we've learned, all the expertise we've gained, all the business practices that we've developed that apply to packaging equipment, apply to other types of capital equipment as well. And also, at the time, they'd also started up an engineering consulting group called Barry-Wehmiller Design Group, also in the 80s, that had grown quite a bit too. And so really Bob and the board said, hey, let's take all the expertise, experience, and resources we have and form another growth and diversification tool within Barry-Wehmiller. And that's what became Forsyth Partners. Now, they could have done that within Barry-Wehmiller, just bought companies and made it a separate division of Barry-Wehmiller Companies.
That's what you'd think they would do, is create another platform.
Yeah, like most strategics do, or even holding companies do. But Barry-Wehmiller is extremely conservative. And I think the concept was, hey, we don't want to risk the mothership. It's performing extremely well. It's profitable, great cash flow. It's growing. So they formed Forsyth off on the side, structured like a typical private equity group. I'll get to our differences in a minute.
Sure.
But allocated $100 million in capital solely from Barry-Wehmiller to us back in 2009, and really just gave us the directive of, hey, Barry-Wehmiller Companies is strong, growing, diversified within packaging and packaging-related equipment services, but we want to get into other areas of other industries really overall to further diversify and further grow Barry-Wehmiller.
Okay, so let's just kicked it off with $100 million. The goal was to diversify. Are you structured like a typical PE firm?
Yeah, so we sell against traditional PE firms, and there's a few areas where we're different. And look, the traditional private equity model has been successful, made a lot of money for the private equity groups, for their investors. I
want to clarify, like traditional, in my view, is you come up with an investment thesis, you got a target fund you're trying to raise, let's say $500 million.
Yep.
You go to all these LPs, you go raise this money, and then you got to go allocate all this capital, and then you got a hold period, and you got to go liquidate, return it, and see how many chips are left over, because you'll usually, 2% a year management fee, 20% of carry. That's typical for some of those of you that may be listening and not familiar, but typical private equity model.
Right.
What do you guys do?
Which Bob Chapman and Barry-Wehmiller do not like the typical private equity model. Not to disparage it, it's where Kyle and I came from. So it's what we did for 8 to 10 years, and it's been a successful model. We like to call the Forsyth model a hybrid equity model. And by hybrid, we mean we've attempted to, I'm not saying it's perfect, but overall it's been successful. We've attempted to take the positive traditional private equity, which I view as still having that entrepreneurial spirit with the leadership team and the company, separate leadership teams, equity aligned incentives so that everyone benefits if they grow and are successful, without some of the negatives, at least negatives in our view. And the negatives in our view is short-term thinking and decision making, and also too much reliance on debt and financial engineering. And then on the strategic side, so hybrid between the positives of private equity and the positives of strategic. On the strategic side, we've attempted to take the positive, which is resources backing of a large, successful global company that gives you not only financial resources and capabilities, but also just know-how and experience from what from what Barry-Wehmiller has done to be successful. But without the negatives of sometimes the strategic, which is, hey, you get acquired by this big company, you kind of get gobbled up, you can lose your culture, you can lose your facilities, you can lose your team members, you can lose your brand. And so what we've attempted to do is blend those two and attempted to do the positives without the negatives. And so if you look at today, people say, well, how are you different than traditional private equity? Number one, as I mentioned, we're long-term. And by long-term, I literally mean forever. Barry-Wehmiller has been around since 1885. They've acquired 85 companies. We've acquired close to 60 now, have not sold a company in that time. And not saying we wouldn't or can't, but the overall model is Barry-Wehmiller is successful. They don't need liquidity. They're our sole LP, always have been. Could that change in the future? It could. It's something we've discussed in the past, but to date, all of our capital, all of our money comes from Barry-Wehmiller. And then also the debt point. When we buy companies, we put anywhere between 2 to 3 times leverage on them. There's certain industries, especially our services industries and businesses, that are very stable. We could probably go lever 4, 5, 6 times, but we don't do that. And so the difference between private equity really is long-term thinking and lower use of leverage and financial engineering. The difference between all of them, I think, is the people-centric side. And yes, there's people-centric companies both within private equity and on the strategic side. But in general, given our long-term backing, our long-term approach, we will sacrifice short-term performance at the benefit of our people if by not doing, some big hire and fire approach. I mean, yes, do we have to make difficult decisions sometimes and part ways with people? Yes, we do, but it's absolutely the last resort in our model. And to us, all of our decision making is what's best for this company and this team over the next 5 to 10 years, not 5 to 10 months or next quarter, like it sometimes can be with the more short-term thinking of both private equity and some, at least public markets with strategics. So
the benefits, you're again avoiding the short-term thinking. It's not like, hey, 5 years. You can definitely go past that and think long-term.
Right.
The financial engineering, you don't have to worry about getting over-engineered, and that puts you in a risk category if you have some macro elements that may fluctuate and change some of the business fundamentals. Then resource backing is an interesting one because you obviously got a lot of things that you found successful in the model, particularly turning culture into strategic advantage, which again is like a whole unique thing that the organization does, but being able to bring things like that as resources to these organizations. So this stuff sounds good. So far I'm sold, right?
Okay,
I'm sold on
so far so good.
the long-term part, right? No pressure to sell. It's not
Yeah.
like we're like exit planning from the beginning. That part sounds interesting. And then when you make investments, are they like majority? Is it full buyout? And then, is there principals rolling over some equity, minority deals? Like, what are your overall?
Yes, as far as structuring deals go, we like to keep things very simple. I mean, you talk to our lenders and our banking partners, they probably think we're too simple and boring, and they would probably like us to do more. But when we structure deal, first to your point, majority, the vast majority of our deals have been 51% ownership or above. We've actually recently done a couple partnerships with some companies where we were less than 50%, but the goal and the clear goal from us and the existing majority owners and sellers know that our goal over the next 2 to 3 years is to work ourselves into majority position. But we do not ever, nor have we ever owned 100% of a business, and we don't want to. Our message to sellers is we have a different story, as I've hit on somewhat, and we want sellers to roll over a portion of their proceeds into the new company. And our ideal ownership structure is probably owning 60 to 80%.
How does the second bite of the apple come in play? Because the typical P model, it's like, okay, 5 years, we'll do another recap, and get another P firm to take over. But you guys are permanent owners, basically. You haven't sold anything.
Yeah, it's a great question, and we get that question a lot. People say, love the long-term approach, love the fact that you're going to make decisions on what's best for the business for the next 10 plus years, not this next year. But I don't want to roll over into this new company, be 90 years old on my deathbed, have 10 million of stock, but have no way to get liquidity for my family.
Exactly.
Logical question. And this really comes from how Barry-Wehmiller operates too, from an equity perspective, because about 30% of Barry-Wehmiller is not owned by the Chapman family. And so they have regular liquidity too. When we partner, and I'll get to that in a minute, when we partner with someone, we say, hey, Keeson, we're going to buy your business. You're going to roll over 20% of your proceeds. Say, let's make it easy. We're going to buy your business for $10 million. You're going to roll over $2 million into the new business and own 20% of the company. We ask for a 5-year, what we call commitment period, when they do not sell. Why 5 years? In our view, that's the low end of long term. And so then you would help with the business in whatever way you want. Sometimes people retire fully, but still believe in the business, so want to have some ownership. Sometimes people stay on as CEO, and their day-to-day operations don't change that much. Usually it's somewhere in between, just depending on where that business leader and that seller is kind of in their life cycle and the business's life cycle. But then after 5 years, they don't have to sell, but then they have the ability to sell. And if we've been successful in that their 2 million rollovers now worth 4 or 5 or 6, they're happy, and then they can start to get liquidity for that rollover. Does that make sense?
Yeah, but so it's not technically a call, because it's on for them. It's a put to decide to, say, hey, I want to cash out, but then who determines the value? Because you're not going to run a process. It's
right. So Barry-Wehmiller since 1998 has used something called EVA, economic value added valuation methodology, formed by Stern Stewart, I think in the late 80s or early 90s. It's a relatively well-known valuation methodology, not just for private companies. I think some public companies use it too. Obviously, it doesn't relate to their public share price. But in 1998, Barry-Wehmiller rolled this out and used it internally. But then for our 7 companies, each one of our companies has its own share price. And once again, back to being simple, whenever we do a new company, their share price just starts at $1 a share. And then over time, if things go well, obviously it grows. And so every 6 months, we update the EVA model. It's basically a 3-year discounted cash flow on steroids, and with inputs on capital structure and interest rates and EBITDA growth and all that stuff. And then so every 6 months, it's we put that in, we review it with the leadership teams have more input in it than the Forsyth team, and then it's blessed every year by Ernst & Young, which are Barry-Wehmiller's and our company's accountants. And so every 6 months, as of March and as of September, which is our fiscal year end, everybody knows what their share price is. So in that example, if you rolled over 2 million at the time of our partnership, you would have 2 million shares in Keeson Company. And then if it's $2 a share 10 years later, you've got 4 million worth and you can sell those.
And then, so I'm committing to minimum 5 years going for the ride.
Yes.
And then after that, so say at 5 years, I'm like, no, things are going good. But then where are my intervals to be able to liquidate?
It's pretty open. What we say is that the 5th anniversary, and that you can sell a third, 6th anniversary a third, 7th anniversary a third, and then after that, it's kind of whatever you want. There have been instances where we've had rollover shareholders that have a massive amount, tens of millions, and they're retired and not that involved in the business. In that situation, we go and have a discussion with them, like, hey, for the financial well-being of the business, let's start to give you you and your family liquidity. But nothing is written in stone. It's like, hey, you have to sell this at this date and exit this date and Y at this date.
Interesting.
You talk to lawyers, they probably say that's a mistake, but everything in our model is relationship-based. It's about trust.
Yeah.
And have all of our relationships gone perfectly in the past? No. There's been a couple of times where we've had a disagreement here or there, but the vast majority of the sellers we partnered with, the leadership teams that have gotten equity either through buying it themselves or us giving them stock options, have gone well. And when they retire or step away, or when they want liquidity for whatever reason, the vast majority of the time it's just a discussion, and that's granted. Of our 7 platform companies, we call 3 of those more established and 4 of those more emerging. And the established ones, two we've had for 14 years, and 1 we've had for 9 years. And of those 3 companies, we've granted and given more than $100 million of liquidity to shareholders that have sold for whatever reason. Either they've retired, or they've hit their 5-year commitment period and wanted $1 million to buy a second home, or wanted $100,000 to help their kids go to college, or whatever the reason is. And so we've granted more than $100 million of liquidity requests over the last, really it's been 7 or 8 years.
Yes, it sounds pretty interesting. Like there is some flexibility that when you reach that point in time, you can work with them. I could probably call you and say, hey, I found a good deal on this yacht. Right? Okay. Can I get out some of these options? And then you've standardized the valuation model, so that's already there. Like right. We don't have to debate that or anything.
We don't debate that. And when we first started, there were some debates like, hey, how's this going to work? Because it wasn't proven. It was proven at Barry-Wehmiller, but it wasn't proven on the Forsyth side. But now, we've got, as I said, 3 very solid case studies of how this has worked. And during diligence, as you can imagine, the sellers, either financial advisor or lawyer or both, usually have a ton of questions about this. Like, what is this, some black box and some magical formula? And so every time at the right point in the diligence process, pre-closing, we'll sit down with the seller and their advisors and walk through it. And there's always some questions about it, but now we show that it's how well it's worked with the 3 companies that we've grown over time. And people view it as a big positive. And Bob Chapman says this, like, we want to be a privately held company and have the benefits of a privately held company, but operate like a publicly held company with our shareholders. We want our shareholders to know that when you need liquidity, it will be there for you. And it's not just to your first point, we don't need to go sell the company for anybody to get their money back.
All the funding comes from Barry-Wehmiller.
Yes.
So do you need more money? Call Uncle Bob?
Basically, call Uncle Bob. But, at the beginning, people ask, what are the benefits of this long-term model? I think I hit on a lot. I'll go off on a little bit of a tangent here, but when we're partnering with someone or looking at a potential transaction, we are very upfront. We say, look, if you want to sell your company for the very last dollar, retire and go to the beach, we are not the right partner for you. Obviously, we pay fair valuations, or else we couldn't have done almost 60 acquisitions now. But we think we are the right partner for you if for whatever reason you want liquidity, whether it's you're 60, 70 years old and want to retire, or you could be 40 or 50. We've done this a lot. 40 or 50 years old have founded this great business, or taken this business over from your parents or grandparents who founded it, whatever it is. You think you've taken the business as far as you can. You want some liquidity for the great business you've built and deserve, but want a good partner to help take your business and your people to the next level. We think we can be that right partner. And that resonates with sellers who care about their business, care about their people, care about their community, care about their legacy, and want to pass that company and that team off to the right home so they can see it just like they've seen it, or their parents or grandparents who are founded have seen it succeed for decades or generations. They want to see it succeed for the next few decades or generation too, after they've entrusted us to partner with them.
You started with the 100 million. You're a lot bigger than that now.
We are a lot bigger than that now. Total we've invested, I think it's approaching about 250 million total. We've done a lot more as total acquisition value, just because with our successful companies, obviously we're able to, internally finance acquisitions either with debt or cash. Total revenue of our company is about 900 million, and we've had 18% returns per year since we did our first deal back in 2011.
IRR?
IRR,
wow.
yes.
How can I invest?
Call Uncle Bob.
Yeah. So one of the things, buyer-led M&A, big thing I talk a lot about. And first part is just having a clearly defined strategy and being proactive about going for companies that actually align with that strategy. One of the big things that you emphasize is this long-term approach on the relationships, the culture. How does that allow you to source deals differently than the competitors out there?
Yeah, so the long-term aspect has been a huge advantage with sourcing. And I'll start off with a failure of ours, which was a big learning. When we first started in 2009, we knew Barry-Wehmiller's relatively conservative view on companies they wanted. So we knew we weren't going to be investing in oil and gas, or media and telecom, or restaurants or retail, some of those either riskier or more capital-intensive businesses. But outside of those few, we were looking at everything, any type of manufacturing, distribution, any services business. And it was really two 30-year-old kids, it looked like, running around looking for investments. So we did a good job of getting our name out there, went to all the ACG events as many do, went and met with dozens, if not 100 plus advisors and investment bankers across the US. Saw plenty of deals, plenty of books came in the door, but we looked up 12, 18 months later, and we hadn't done our first acquisition yet. We hadn't really gotten far with anything. Bob always likes to joke that Kyle and I would go home to our wives and cry every night because 2 years in we hadn't done a deal. It wasn't that bad, but so we stepped back about 18 months in and said, look, whatever we're doing right now is not working. There are hundreds of other small and medium-sized private equity groups out there that look just like us, that have money. Our conservative approach is an auction where 200 potential buyers see a book. Yeah, we might get in management presentation be top 10, but we're usually not the one paying the most out of 200. So we stepped back and said, hey, what do we know? And we knew two industries extremely well. We knew capital equipment manufacturing because of the Barry-Wehmiller angle and experience, and we knew insurance services. And that was mainly because Kyle and my years at Bank of America, they did a lot of insurance investing, given the fact that they were part of a large financial institution. And Kyle specifically was kind of the mid-level partner in that space. So we said, forget everything else. We're going to go from being, an inch deep and a mile wide to an inch wide and a mile deep. And we went deep into, a handful of sectors within capital equipment and less than a handful, probably 2 or 3 sectors within insurance services. And the whole thing, basically turned on a dime. We did our first platform investment in Core Partners, which is the office we're sitting here now, in April of 2011. We did our second in Machine Solutions, which is a medical device equipment company of ours that's based out in Flagstaff, in November 2011. We did our third platform in April of 2012. And so we went from getting no traction over 2 years to buying 3 of our platforms in the next year. And so back to the point of how our sourcing model works and been successful, you need to be more than just capital and need to be more than the money, especially with buyer-led M&A, as you're touching on. I mean, you need to have a real advantage and a real story, and you need to be able to stand out from the other 100 plus, financial buyers out there that look just like you on paper and are trying to buy companies. So because as you know, when you talk to a business owner, especially if you're talking to some 60-year-old business owner and you're this 30-year-old kid, they would know within 30 seconds that I had no clue what I was talking about with the distribution business. I mean, I read the SIM, I did some research, but within 30 seconds, there's like, well, this guy doesn't know what the heck he's talking about. Within capital equipment and within insurance services, Kyle and I were pretty well versed with that because of our experience either at B of A or experience learning the Barry-Wehmiller business. You can quickly get in and they say, hey, this is a group that understands my business that I can trust. And then on the flip side of that, or not the flip side, but even further, when you talk about the Barry-Wehmiller model and say, hey, we're long-term, we're not traditional private equity, we obviously are going to pay a fair price, but we want to partner with you because we think we can take your business from X to Y over the next 10 plus years, and we're going to be a great home for the company that you built and the people on your team. It's just an advantage. And on the sourcing side, early on it was just Kyle and myself, and now we're 16 people. I mean, everybody in our group is responsible for sourcing. Yes, we have a deal origination, business development person, actually a couple of them, that's 80% of what they do. But all 16 of us have some responsibility with sourcing. And if one person's the capital, 4 or 5 people are capital equipment experts. They're going to trade show. They're going to a dozen trade shows a year. They're still sending letters and Bob's book out, 100, 200 times a year. They're still having follow-up conversations. It is constant with us with forming these relationships because the vast majority of the companies that and teams we've partnered with, we've had multi-year relationships with. I can count on one hand how many, books fell on our desk or came through email and said, oh, that sounds interesting. Let's look into it. I mean, yes, we do that. We compete in those processes. We get a lot of management meetings, but we just don't have an angle in those situations. And a lot of times those are private equity owned companies or whatever it is. And capital is the main thing they're looking for. And as you know, there's plenty of capital out there. There's hundreds of firms that can provide just capital. We like to provide something in addition to that. 90%
of your deals are proprietary.
Yes.
That you've executed.
Yeah. And by proprietary, I mean, we had a relationship.
Yep.
I want to be clear. It's like, I'd say probably half the sellers were only talking to us. And that would obviously be our preference. But our model and our preference is find an industry we like, or a narrow sector within industry we like, go deep in it, get 10, 20 relationships. And the vast majority of the time, as you would imagine, someone gets a letter, or we make an introduction to someone at a trade show. They like our model, but they say, hey, Ryan, appreciate it, but I love what I'm doing. I got 10 years left in my career. I don't have any interest in selling, but like your model. And when the time comes, let's keep in touch. And so a follow-up to that is logically, I mean, we usually try to have 1 or 2 touch points a year with people like that, whether it's going to the trade shows and seeing them again, or, hey, I'm going to be in Omaha and you're based in Omaha. Can I swing by for lunch? And just keep that relationship going, because our goal is when the time comes for a business owner to sell or consider selling or partnering with someone, we want to be their first call. We understand we're not always going to be their only call. We understand their advisors or whatever might say, hey, it seems like a fair price, but let's check the market. But typically we are their first call and their preferred buyer if we can come up with a competitive price and structure.
So your differentiators, just story, really position yourself to stand out so it doesn't sound like everybody else's pitch. And really emphasizing the long-term play that you have. And then and the vision. If you sort of click into this company and see where you can better together, have that combined vision of what that's going to look like. and then you build these relationships. I get the, hey, this sounds good, but now's not the right time. And you want to be that first phone call. There's two things I'm wondering about. One is, how do you sort of get actionability? Like, I don't have patience. I don't know. Yeah. I don't know if you picked up so far, but yeah. I can't wait for that. I want to get things actionable. Like I want to, figure out how to make that possible. Do you have a view on that? Like, do you convince people to sell their company? It's one piece. The other one is, let me get back to the other one. I want to tell you the other one. The other one. Let's start with this one. I want to make sure we get deep in it.
I don't have a ton of patience either. I think all my kids and wife would say that. But in this model, you have to, because this model being relationship based, it is based on trust. Almost all the companies we've bought from a founder or family owned business, and it's more to them than just a number. It is their legacy. It's their family's legacy. And so they need to trust you that you're going to take care of that business. And the minute you get pushy or try to force something, I think that destroys the trust. And they think, oh, this guy's just here to do a deal. It doesn't, So how we do force something, to use your words, I mean, just be that touch point, just remind them annually. Like, we don't call them up and say, hey, you ready to sell yet? You ready to sell yet? It's, hey, I'm going to be in town. Would love to grab lunch, swing by the facility to see you. Going to be at this trade show. Going to come by the booth. Can we grab a drink? Whatever it is. It's just the constant reminder. And when you do get into those, when you do meet them, you get into the conversations. Hey, how's business going? They tell you, and vice versa. We tell them how's going, and you nicely and softly express the interest. Reiterate why you're interested, what you can do with the business. Because there's been a lot of instances where, yes, a business owner liked working with us, liked our model, but had no interest. But, we probably were able to convince them that now could be the time. I mean, so many people think I'm going to sell my business when I'm ready to retire, right?
I know this is a big, this is one we should definitely take apart, because this is a huge misnomer.
Right. That is, and that's logical, right? I mean, especially a family business. People think, oh, well, my grandfather founded it. My mother inherited it. She ran it for 30 years. She passed it off to me. And, when she was 70 years old, and now I'm 50, but I feel like I need to, hopefully I'll pass it off to my kids or whatever in 20 years. A lot of our partnerships have been what I said earlier, is that, somebody's taken their business as far as they think they can. That's not a knock on them. I mean, it's, we find there's this 20 or 30 million revenue number that a founder or a family business can not easily, running and growing a business is never easy, but logically get to. And then they sometimes just kind of hit a ceiling. And it's kind of up to us to convince that, hey, you might still have 10, 15 years in the tank. And by the way, we want you to have 10 or 15 years in the tank, because you know this business and this industry better than anyone. Well, I'm never going to know a business better than someone who's been in it for 30 years. Yep. But you know what? We've got these resources. We have these, different things that we can bring to your business. Why don't you take some money off the table? Let us buy 60% of the business. You retain 40%, and we'll grow this thing from 30 million in revenue to 300 over the next 10 years together. And, that money that you rolled over is going to be worth 4 or 5 times as much as what you took off the table today. And if I don't know the numbers. I probably should go back and look at this, but I'd say at least a third, maybe half of the companies that we've partnered with and acquired have been in that situation. We've kept the seller on as CEO or president or whatever role they had, and we worked together to continue to grow the business.
So if you talk to a banker, they'll probably tell you should think about your exit a year ahead. But I feel like between you and I, it's more like 5 years plus you should start thinking about it, because that's where it becomes more attractive for working with an organization like yours. It's like, oh, we're going to be around for 5 years. You're going to be roll over the equity. And you sort of are hitting at a peak value, because if there's, I'm going to retire in 3 months, we're trying to sell this, you're going to take a knock on valuation because of that.
Right. Yeah. And at least with our model, if somebody says, hey, Forsyth, I want to sell my business. I want to sell it within a year, and then I'm going to retire and go to the beach. And I'm going to take I'm going to sell 100% of it, it's a little bit of a red flag.
Yeah, exactly.
I mean, unless there's some life event that's happened, but it's a little bit of red flag. It's, hey, are you selling at the peak? Is something wrong with the business?
You're going to perceive it as more of a risk deal, and you're probably going to lower the valuation on it.
Yeah, absolutely.
Okay, good to know. So now I got to ask you this. How do you build a relationship and everything's going good? Hey, Ryan, this and that. But they get a banker and they turn the process competitive. And it's a view of you got a leg up because you got the relationship. One, it's like, how do you use that? But two, is there a way you can keep it from getting competitive? Because that's the thing that you just talked about. You don't want to try to outbid 200 people.
Right.
And it's not fun.
Yeah, I'd say the answer's a little bit in the middle. I mean, companies and people we're talking to are rarely the ones that are going to go hire an advisor to do a full, massive 200-person auction.
Okay.
Oftentimes they do. And honestly, sometimes we prefer to have an advisor involved. It can expedite the process. It can make it cleaner.
I agree on that. I just don't want like a full blown auction.
Yeah. But it's of our almost 60 deals, no two look exactly like or followed the same process. But there's been a handful of, hey, we just had a real trusting relationship with someone, and besides a lawyer to help them mark up the purchase agreement documents, there was nobody else involved. But the vast majority of the time, there's some advisor involved. It could be, a broker that the guy knows, or his lawyer that's also,
But is there a way to keep them from turning into a full blown auction? You sort of.
I mean, the way is to be fair up front. I mean, people know if you're trying to nickel and dime them. I mean, if I got a great relationship with you over the last 4 or 5 years, and finally it's time for you to sell your business, we know the business. Or I would know the business from working with you. We've got this relationship, and then if I give you some offensive offer,
you're probably having like casual conversations about valuation. We could say, hey, market's like 6 to 8 EBITDA, for this type of business.
Yep.
And we're gonna offer, we like all this stuff. We see the potential. We're gonna offer you like higher end of that. And there's this trust, and it's like, this makes sense. This sounds good. I don't think it's worth us going around. And I almost look at our business, right? We're talking to investors, and I feel, and it's different, right? It's more of like a minority type of deal we're working on, that I would definitely give up a turn evaluation knowing it's going to be an awesome partner that 5 years down the road, and we'll look back and saying, whoa, that was like a great ride that worked well together, versus just trying to, not get that partner that's going to be a creative value add and a good journey to go with.
Right. And, at the end of the day, we can't control what the seller decides to do. And as I said, oftentimes I would prefer to have an advisor be involved because, A, it's somewhat of a market check on our price, and could they get a higher price by 5 or 10%? Yeah, maybe, or a turn, as you said, maybe. But at least it's, hey, this is fair. And also, when we lay these proposals out, it's not just, hey, we'll buy your company for 6 times EBITDA. I mean, we 6, 7, 8, whatever it is, we lay out what the next 5 or 10 years could look like. And once again, with the whole rollover equity aspect, it's, hey, you'll take this off the table today, you'll roll over this, and if we're successful, if we hit the 18% return that we've been able to do, fortunately, for the last 12 or 14 years, your rollover will be X. Even if we, make 15 or 10, we're not. Our target returns are 15%. That's usually what we show people. But then we also show 10 and 20 and a range to say, hey, here are the ranges of outcomes and what your total deal today would be worth in 5 and in 10 years. And that's usually, while they could probably go find a buyer to pay a little bit more today and be all upfront cash.
Get the long term.
If you look at the long term outcome, they're going to be a lot better taking our option than just selling everything today.
When you think about some of the metrics, do you have any rules of thumb? Like a lot I'm tech, obviously.
Yeah.
And if I talk to some of those super smart investors out there, they'll kind of look at like 5 years out. What's this journey look like with the anticipated value, and then basically divide by 3 to get an idea of like where current value should be to see if we can get aligned around that. There's like rules of thumb that you have for thinking through some of that.
Well, the typical rule of thumb, as you know, is maybe not on the tech side. Maybe that's more multiple of revenue, or that's why I love my industry. Stratosphere that we don't play in.
That's why I love this.
On the capital equipment side, depending on the sector you are serving, it can be anywhere between 5 and low double digits, 10, 11, 12 times. On the insurance services and financial services side, it can be anywhere between 7 to 15 times. So, and our historical multiples are probably the midpoint in there, but we have obviously higher growth, higher margin industries are going to command a bigger multiple. And
that's probably what it is, because it's so much of foreshadowing of like where the business is going to go, where you do have more standardization, which you already talked about, standardizing your whole valuation approach across the organization, that you would look at that in terms of pricing the company. But then you're building out this vision of what that long-term value is going to look like.
Yeah. And to your point, yes, it's a standardized valuation approach, but it's company and industry specific. We're not going to, the EVA model that we use doesn't value a high growth financial services company the same as it does a mature, lower growth, lower margin capital equipment company. So within that, yes, the EVA methodology is very standard and the same, but the inputs to those two examples are vastly different and spit out a vastly different valuation and multiple.
Aside from rolling over equity, are you using any other tools? Are you using earnouts, seller financing, other things?
We'll use seller financing every once in a while. I'd say 10 years ago, we used seller financing more and earnouts less. Today, it's the opposite. It's a lot more earnout based.
Why is that?
I think part of it is companies have been on a great run, and the owners think that run's going to continue, and even regardless of valuation that we're putting forth or some other competitors putting forth, they still think, they look at it as like, well, if I sold it today, I could get this, but if I just run it for 3 more years and I continue to grow 10% a year, it's going to be this times 1.5. And so earnout's just a way to bridge that gap. And look, when we structure earnouts, I want to pay it. Right? You don't want to, sometimes, and it's become less this way, but I feel like 5-10 years ago when you'd structure an earnout, the seller would be like, well, there's got to be some gotcha in here, right? How they're trying to screw me somehow. And I want to pay earnouts because that's a win-win. And we structure earnouts so if we do pay them, it's a better outcome for Forsyth as well, because the company's more profitable and it's growing as much as we all thought and hoped it would. But our probably more 50% or more of our deals these days have earnouts in them.
Wow. I laugh because I just had this roundtable discussion yesterday. I hosted with a mix of private equity and corp dev folks, and I kind of said half jokingly, but what if you structure a deal where you don't intend to play the earnout? And that conversation stemmed because like the bid ask spread is so high right now.
Yep.
It's just people always look at these headline valuations and they reference it. And that's the thing I'm personally struggling with. Or they're just like the hockey stick growth, right? You get any book bang for bang, any book, it always shows this.
You don't always believe those?
Well, I'm like, well, sure. Why don't we build an earnout against that? And if you hit those numbers, great.
Yeah, everybody's happy.
We'll pay you what you're looking for here. That's where I was kind of like half joking. I'm like, well, can you just structure the deal without the intention of paying the earnout? Because
and I'm, maybe sometimes that happens, or people put such insanely high targets in there, they're not going to pay out or only pay out a small portion. Back to our model in long term, it can be very damaging to the relationship if there's a deal with a big earnout component and 1 or 2 years into the earnout period, it's clear that they're not going to hit it because they're, demotivated.
What is your earnouts usually based on?
It's usually based very broadly, usually based on gross profit or some gross profit number. Revenue sometimes can be too simple because, people can.
Yeah, you're right.
You say, hey, just push revenue. I don't care what the margin is.
Yeah, just dump it all on marketing.
We don't want a bunch of revenue but no margin. And then in my view, EBITDA can sometimes be just too complex and too controversial to,
That's
to measure.
Adjusted EBITDA, baby.
Yeah. Well, and also we want to make investments. Like we want to make significant investments in these businesses. And a lot of times those investments are in people, whether it's engineers, salespeople, whatever it is that we would put below gross profit. And so that's only fair. And we don't want to be in a situation where we're saying to the seller, hey, we need to go hire 5 engineers. It's going to cost $500,000. And they're thinking, well, that's going to hit EBITDA by $500,000. And so we try to make it, and there's exceptions to that, but in general, it's a gross profit based earnout. Sometimes if there's big customer concentration or something, it's retaining the top customer for these 5 years or growing that revenue. But the general answer would be gross profit.
Fair enough. Hey, so in terms of nurturing these relationships, you mentioned meeting people in person whenever you can. It's like a big thing. Have to be in town. Is there anything else that you're doing to really build that trust? I like to take people out for drinks. I feel like alcohol kind of
that usually helps.
See a little other, more personal side. What else? There's always comparing notes. Hey, guys, grab a call and just kind of trade some notes.
A big part with us is having them come out and visit our companies. Now it's the same point as you're spending time with people, but it's one thing to hear our story. It's one thing to read Bob Chapman's book, Everybody Matters. It's one thing to look at the website and read about truly human leadership and our people-centric culture and our long-term success. But those are all words, and those are all conversations from someone who's clearly does have an ulterior motive of convincing you should partner with us. But we and this could be when we still think, hey, you're not going to be ready to sell for 5 more years. If we really interested in someone's business and want to build that trust and partnership, we'll say, hey, come on out to Iowa and visit some of our manufacturing facilities, or come down to Atlanta and visit our headquarters and meet our people and see for yourself that what we talk about is real.
This is interesting. This is like our sales cycle. This is equivalent of doing a product demo.
Yeah.
You're like, come see.
And somewhat related, we also offer up them to, talk to any of the companies, the previous owners that have sold to us, the existing leadership teams, kind of the equivalent of customer calls and customer checks. But we are an open book, and we share our financials with anyone, whether they're good or bad at that point. I mean, our view is people selling their business to us should do as much diligence on us as we're doing on them. Because when you say to someone, I want to partner with you, I want to buy your company, and by the way, your entire leadership team, I hope they're with us for the rest of their career. I mean, that's powerful.
Yeah.
And it's scary. It can be scary too. It's not like traditional private equity. Hey, we're going to do this transaction. It's going to be successful. Hopefully 4 or 5 years we'll sell. We'll make 3-4 times our money. Everybody will be happy because they make a lot of money. People can do something for 4 or 5 years for monetary motivations. If you're talking about partnering with a company for 10, 20 years, I mean, you need to have that relationship and you need to have that trust, because I don't know about you, but I don't want to be miserable for 10, 20 years.
I agree.
Even if I make a lot of money,
that's
not a good trade-off for being miserable or having
it's a bad marriage, baby.
Yeah, it's a bad marriage.
We don't want that. I do like that approach a lot. It is, it's like, here's your business case for doing a deal, but then you're validating it and just getting certainty by having those interactions and so forth. What are some of the key mistakes first-time buyers make when executing M&A deals?
I would say, and it still happens, 20 years in for us, is getting too emotionally attached to a deal.
Really? You don't come off emotional?
I know. I need to come off more emotional. And of course, it still happens.
That was a bad joke of people in private equity. Don't take any offense. I don't want people messaging me.
I've been made fun of my robotic monotone voice my whole life, and even when I try to fluctuate, it still comes off that way. So you're number 100 of the people that commented on that.
Well, that's all right. There's plenty of people actually go to sleep listening to this podcast for my monotone voice. So this episode,
maybe we can help.
This is the deep sleep episode right here. Maybe you're going to get your REM.
I'll say, and a little bit of our model too, I made a joke a little bit earlier about how, Bob Chapman would say Kyle and I would go home crying to our wives the first 2 years because we hadn't done a deal. One of the biggest benefits of that model and the long-term model is there was never pressure to do a deal. There was actually more pressure to not do a bad deal than there was to do a deal. And how that relates to, your question about mistakes people make, especially early on, is just that pressure, whether they have it, whether they have the monetary pressure to do a deal, like some traditional private equity, you raise that fund, the clock starts. You buy that company, the clock starts. And it starts for logical reasons, but that's just the case. But, especially in our model, when you've got a relationship formed with someone, it's not just a financial transaction. And then you get into diligence and something pops up. Obviously, something negative pops up in this situation. It's just human nature. It's like you got a relationship, you want to do this deal. It's often very easy just to overlook. It's like, oh, it's 1 or 2 things out of 10. Deal's still going to be fine. Everything's going to work out. And I think that's probably the biggest mistake some people make early on is to, it's been very rare that we back out of a deal or change terms or anything like that. But, if something material happens that changes the prospects of a transaction, you should do something about it. Now, you should be fair. You should explain to the seller, hey, this is what we found. Still want to do the transaction. And that's a great situation where maybe some of the proceeds go to an earnout or something like that. But back to the original question, I just think it's very easy to get emotionally attached and therefore just kind of have blinders on and want to go, full speed ahead, regardless of what
the red flags and stuff.
Yeah, what the red flags are.
I like right now, we have never, we're still a small company, like 10 million revenue, 50 people, but I'm so eager to do a deal. Like especially doing all these podcasts.
Which is natural.
I know. And then you get friends. Like, I'm fortunate to have good friends, and they're like kind of a mix of just trying to cue me to pump my brakes or just getting ready to give me that quick slap across to get some sense. And it's like, like really think this through, which I'm fortunate for, but it's tough because it is. I get it, what you mean. I think I have like a different way of thinking of it versus emotionally attached. But it's what it is. I feel like there's like eagerness to do a deal. Right. There's like just deal fever. But then I have the same thing. Like I just got, clearly there's some bad misfit with management. Like that's not a good thing. Yeah.
Well, and to that point, you said, what's the biggest mistake? I'll maybe say a second mistake too, is underestimating the importance of culture and people. And so many people, including myself in this industry, come from a very financial data-centric background and they say, oh, it looks great in Excel, which you can make anything look great in Excel. But when it actually comes to executing that strategy with the leadership team, all of our deals have failed or succeeded because of people. I mean, yes, there could be industry dynamics. Yes, there can be, product failed or whatever, but it all comes down to people. And this is not just, coming from the people-centric culture side. I mean, everything comes down to leadership and people. You can have the best plan in the world. If you don't have the people to execute that plan, it's not going to succeed. If you've got an okay plan but have great people, I would rather have that than the latter. Than the former. But so I think underestimating or even not even paying that much attention to the people and leadership aspect of things is a big mistake too.
Yeah, you're making it hard for me, man. That's not helping me.
Sorry.
I got one is like definitely bad people.
Just pay attention to that Excel spreadsheet that makes everything look great.
I know. Yeah. The other, I found one I really do like the people a lot. So we'll have to see how that one pans out. Early, but. Well,
good luck.
Yeah, I know. I might have another fork in the road I'll hit and be giving you a call, before I tear in my pillow at night. I definitely got to touch on integration and operational improvements post-acquisition. Mm-hmm. Is there a different view? Because I know I had a great conversation with Bob and Kyle about the broader organization, the big emphasis on culture and how they just use that as a strategy that when they buy an organization, they're going to change their culture. Like that's their full-on intention.
Yep.
Is there a different view on how you integrate companies within Forsyth?
I'd say that's very similar. We have an M&A and an integration playbook, as we call it. And in our view, it's kind of more of a menu approach. I mean, during diligence, yes, there's clearly maybe 2 or 3 areas that we think a company could improve upon. We open up completely on either the Forsyth companies or even a little bit of Barry-Wehmiller, and they might pick or choose 2 or 3 things that they think could help them. And then we really get together and say, hey, of this menu of 15, 20 things, we think it's these 2 or 3, you think it's these 2 or 3, maybe a couple overlap. If that's the case, it's obvious. But then we have a discussion. What we don't, my view on integration early on is less is more, because we learned very early on that when you start a partnership with everybody, everybody's excited. Everybody wants to impress, both on the Forsyth side and the company side. And so they took on too much. And maybe they take on 6 initiatives for the first year because you've got this kickoff meeting, everybody's excited, and then they go back to work, and a month in, they're like, wow, this is a lot of work. And they can't execute on them. And either things fall off or things take twice as long as you thought they would. And so we have very much kind of a less is more approach of, hey, if we think we should take on these 6 things, maybe let's just take on 3 or 4 and resource them properly and make sure they're successful. And especially with our long-term approach, if it takes us 2 years to accomplish number 5 and 6, that's fine. Let's just make sure, number 3 and 4 are accomplished in the first year.
Yeah, you want to set a good cadence for achieving these milestones versus like screwing that up in the beginning and then it's just not a good relationship. So that makes sense. So really similar, following it. Again, would reference and encourage folks to listen to the podcast interview that talks more about the culture and that integration approach with Bob and Kyle Chapman. We talked about leverage earlier, and that you tend to be more conservative. Mm-hmm. It's like 2 to 3x, and definitely know a lot of folks go a lot higher than that. Does that impact like the types of deal you pursue, and just broadly, like withstanding economic cycles? Like, how do you see that factoring in? The
types of deals we do know, and the reason is we model everything out and look at everything on unlevered returns. So whenever we look at a business, it's like, hey, what can we grow it to with all equity financed? And then we back into what's the appropriate valuation to pay. So back to the tech sector or something, could we pay 20 times EBITDA for something with no leverage? Probably not, but that's not where we're not in the high tech sector.
And that would be revenues, by the way.
Oh, sorry, revenues, even more so.
Yeah.
But the last part of that question, nobody hopes a recession happens or a downturn happens, just, given the impact that it can have on economies, countries, people, and that stuff. But we have found, given our model, that when there's some disruption, whether it's a recession or capital markets come down, it's weird, but activity for us picks up. And a perfect example of this is COVID. And, think COVID was 2 or 3 years long, and it ended up being a boom for capital markets because interest rates went almost to zero. But remember those first 6 months of COVID, call it March through September of 2020. Nobody knew what was happening. Mm-hmm. Markets crashed initially, and M&A completely dried up. And we did 6 deals in those 6 months. And what happened, at least this is my theory of what happened, I've never gone back and confirmed this with the sellers, is all 6 of those were companies that we had been talking to for years. All 6 of those were companies that were experiencing that boom of the 5-10 years before COVID. That was a pretty strong economic time for most industries and companies. And then COVID happened, and a lot of these business owners said, well, I don't know if this is going to last 6 months or 6 years. I don't know what the outcome is going to be for my company. I'm going to call Forsyth. And they did. And given our company, and yes, some of our companies had a little hiccup down, like all did. Now they ended up coming back, given what the broader economy did, and in most sectors at least. Capital equipment was a beneficiary. But in all those instances, we said, yes, we're still interested. Yes, we don't know what's going to happen over the next 1 or 2 years with COVID either, but honestly, we don't care. We're in this for the next 10 or 20 years. And so we did 6 acquisitions in 6 months where the rest of the market was pretty slow. and given the uncertainty. And we did that because we still believed in the long-term aspects of our platform companies that were acquiring these add-ons, but on them too. And we got them fully debt financed by our lending partners because they trusted us, and we were still 2-3 times levered, and not 4, 5, 6 or whatever it was, and all 6 of those ended up being great acquisitions for us, and are still with us today and continue to grow.
It's so interesting that you don't model the debt on; it's all off of equity.
Yep,
and you still use that to get your target IRR. Because it wouldn't I feel like everybody would just put the debt in there so you could say, hey, we can do more deals. And then I have like this broader pro forma of.
Yeah, I'm not saying it's the right way. It's just kind of, back to the conservative approach we take. It's
you guys are some true Midwesterners over there in St. Louis.
Just boring, simple Midwesterners.
Well, I was coming back with some good returns because I want to give you my money.
Yeah. Well, and also you mentioned earlier about Barry-Wehmiller being the sole funding source. We have considered potentially looking at other parties. Probably be like-minded, high net worth families. And we actually talked to a couple of placement agent guys, just to say, hey, here's our model. And they said, 18% is not top decile. But if you look at it in a risk adjusted basis, it probably, top decile, top quartile, because our companies are so lowly levered. And it's kind of, once again, back to the conservative nature of Barry-Wehmiller's model. I'll take 18% returns all day and sleep well at night than pushing for 25% returns and bust covenants and have to, hand the keys over to company to the lenders any day.
That's so true. And it's interesting too. If you look at those public pension fund like Calipers that post all their data, a lot of funds don't make, 15 is really good. There's so many of them performing below that. A lot of them. I'd be curious.
We've been very fortunate to have some great companies and great teams so far, but it's getting harder. I'll say that.
Somebody has some good fund data. Reach out to me. I'm kind of curious to work on some content around there.
Yeah, there's a lot of data out there, and as you can imagine, people can cut it any way they like. But
the good stuff's behind a firewall, and they want you to pay $50,000 for it.
That's true.
So we'll see. But I feel like somebody could sit there and compile from all these public sources and make a pretty good,
right?
Resource out of it. I don't know. Marketing team, I'll give you a task to do on that one. Where do you see the M&A market heading in the next 5 years? What are the trends shaping how investors approach acquisitions?
Yeah, I know we're in a little bit of a M&A lull right now, but just given some of the uncertainty, I think it's going to be absent a major recession. I don't think this lull is going to last long, and I would expect it to bounce back pretty quickly. There is just so much money out there. I mean, as you know,
that's true.
Chasing fewer and fewer good companies that. As I said, I think it's going to take a massive economic downturn to change that in the medium or long term.
So near term, I'm with you. I'm like, we had a lot of things happen thanks to our lovely administration here.
Yeah.
But it's settling, and that's what I anticipated. Dust will settle, and then because a lot of these I've seen companies are just ready to go on market, but they're just waiting because they don't want a new big regulatory change. But if we go out even 5 years out, right? Because right now we're working on a deal. I start working with someone like you. Now we're kind of on this 5-year journey together at the minimum. What do we see happening then? Because you've got a strong point that there's so much capital. I got in this industry early 2000s, and anybody in PE was on this pedestal. I mean, you went there and you tried to kiss the ring and just get in front of them. Now it's just like everybody's got a cousin in private equity that's got hunting for deals. And then there's so many, now we saw the explosion with the private credit.
Yep.
Now we're getting retail, all these big PE firms are getting into retail, and it's just putting more and more capital into these private equity platforms. What do you think that's going to do to, are we going to just see these valuations keep going up? We always think I referenced, maybe your business will start trading like the tech revenue multipliers.
That'd be nice. Boring old capital equipment companies. I'd love those to trade at 15 times. But I think, first off, I think return expectations and actual returns will come down gradually.
That's a good point.
Just given the insane prices that are being paid. Now, I've been saying that for 5 years, and the prices keep going up. So I could easily be wrong. So I just think, I mean, you pointed out, 10, 15 years ago, good private equity returns were in the low 20s. Now they're, as you just said, probably mid to high teens. And will they come down to the low double digits? I doubt that. I mean, I think the mid to high teens is still probably expectations in this overall industry. But I think, just for the reasons we just talked about, I just think overall returns, both on the actual side and the expectations, will naturally come down just because price is being paid.
That's a good takeaway. I think that's you're kind of right. You can explode value up to a certain point, but there's got to be a return. But because of that, the expectation of those returns have to come down.
Yep.
What's the craziest thing you've seen in M&A?
I'll maybe poke fun at myself a little bit. Back to those early years. I mean, the craziest. I don't know if it's crazy, but just like the extent of what people will do to get deals done. And there's a good story on Forsyth, and I won't mention the company's names or what they were, but kind of Kyle was covering one and I was covering one. There's these two companies that both of us identified early on as, hey, this would be good for our model. And he chased one and I chased one, and we met with the owners, probably at least 10 times each. Every time we'd come up, with our latest and greatest proposal for you talk about like trying to be pushy and trying to convince someone. Mm-hmm. That's how we were. We never ended up buying those companies, and maybe that's why not. And even one of them ended up coming to market, and then we passed on it because we had gone elsewhere. But just when starting up a company, and you probably feel this way too, with looking for your first acquisition, but just the extent and craziness of, hey, they want to talk to us again. But refresh that presentation, do it again, do it. I mean, it's an ongoing joke across Forsyth of Kyle and My's early days, and just, I wouldn't say how desperate we were, but just how hard we were trying to make a few deals happen. But that ended up not happening. And we look in hindsight, it's probably a good thing that they didn't. But I don't know if that answers the question. But
it's kind of wild. Well, it is like the chase, but it's almost kind of, I don't know why I keep always referencing like marriage and dating. There's like an element of playing hard to get and banter back and forth to.
We weren't playing hard to get. We were easy to get.
Well, that's the thing.
They just didn't want us.
If you're trying too hard, then you're kind of being the creepy guy at the bar.
And we were the creepy guys at the bar that just kept going at it and kept getting turned away.
Yeah.
But it makes for a good story and fun. And making fun of each other.
Now you got a great game. You got a great story to tell. Yeah. You got ways to validate it, and
No, but it's been, first off, this has been a great conversation. Really appreciate the invite, and I do encourage everybody, if you listen to this one, definitely listen to the Barry-Wehmiller one with Bob and Kyle, because Forsyth's been successful. It's been the most fun and rewarding I've had in my career, and even from a personal side too, working with great friends and great people. But it all starts with Barry-Wehmiller and what Bob has created, and what Kyle's now bringing to the next level and the next generation. And the key is relationship and partnership and trust. And when you have that backing, it's a lot easier to go out and do what Forsyth does and make it look easy. But it's just because it's real simple. Just do the right thing. It's really simple to say that. Sometimes in life it's harder to do that. But with business and with partnerships, I like to think that we usually do the right thing. And because of that, I think it's a big reason of our success.
That's the culture that drives success. This has been great, Ryan. I appreciate you taking the time to have this conversation. Anybody still listening to this? My fellow M&A scientists, thank you. I really appreciate it. I always welcome feedback on these podcasts. Connect with me on LinkedIn. I'll take the criticism. I'm sure trying to get better at doing this. And topic ideas are always fun. If there's stuff I haven't covered yet, love to get those topic ideas. Till next time, here's to the deal.